Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Datadog.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total costs before signing anything.
So imagine watching a multi-billion-dollar, super mature enterprise software company, right?
Right.
And suddenly it starts trading with the explosive volatility of like a meme stock.
Which is wild.
It is. But that is exactly what we're looking at today. We are breaking down Datadog, which just had its biggest single-day pop since its IPO.
It completely shattered its historical trading record.
Oh, entirely. I mean, the stock surged an incredible 31.33% in the single session.
Yeah.
It closed at 188.73. And this earthquake, it all comes right after they completely crushed their first quarter 2026 earnings.
It was a monumental move. I mean, a 31% gap up in a single trading session.
For a company this size.
Exactly. For an established company of this massive size, it's exceptionally rare.
Yeah.
It completely shifts the landscape for anyone holding this stock in their portfolio, or even anyone who's just been, watching cautiously from the sidelines.
Right.
It forces a total reevaluation of the asset.
Exactly. Which kind of forces us to ask the core framing question right up front.
Let's hear it.
As an investor trying to navigate this environment, you really have to decide, is this massive rally just a short-term squeeze, like a temporary explosion of market volatility? Or are we witnessing the start of a massive structural shift? A shift where artificial intelligence goes from being perceived as a threat.
Which it has been.
Right, a threat that might disrupt traditional software. But does it now become an absolute, undeniable tailwind?
That is the exact tension driving the entire market right now.
Yeah.
For the last year or so, the prevailing fear was that AI would cannibalize traditional software as a service models.
Because everyone thought companies would just build their own AI tools.
Exactly. Investors were terrified that companies would build their own internal tools and just, abandon third-party software altogether.
Right.
But what this specific earnings print showed us is that for the right platforms, AI isn't a threat at all.
No, not at all.
It's actually a catalyst for unprecedented massive demand.
All right, let's move into the wealth building context.
Yeah.
Because if you are managing a portfolio for the long haul, you aren't just chasing a one-day 31% pop.
Definitely not.
You need to understand the underlying tectonic shifts here. And the foundational shift happening is that AI workloads are fundamentally changing.
Yes, they are.
We're finally moving out of what you might call the artisanal research phase of AI.
I think artisanal is the perfect way to describe it.
Right. Because for the last couple of years, AI was essentially a luxury experiment.
Yeah. Highly paid data scientists sitting in a sandbox.
Exactly. Tinkering with large language models,
Yeah.
running localized tests. It was cool, but it wasn't running the global economy.
Oh.
But now it was moving into heavy, massive production scale.
Real-world application.
Exactly. We're talking about AI running live, dynamic e-commerce pricing engines on Black Friday. We're talking about autonomous logistics networks.
And real-time algorithmic trading platforms.
Right, where billions of dollars move in milliseconds.
And the second you move from that isolated laboratory into live global production.
The stakes go through the roof.
Exactly. The stakes change entirely. You cannot afford a single second of downtime.
Which brings me to this analogy. Think about a Fortune 500 company building out this massive enterprise AI architecture.
Okay.
You can think of the AI models themselves as the brain, right?
Sure.
And you can think of the physical data centers and the massive cloud servers as like the skeleton and the muscle.
Right. The hardware?
But Datadog is the mission-critical nervous system.
Oh, that's a great way to frame it.
It's the observability platform that sits underneath all of it, constantly sending millions of telemetry signals, warning you of latency, and catching catastrophic errors before they actually cause a system failure.
Because the system is too complex for humans to monitor manually.
Exactly. Let's say you are running a live checkout system. If an AI microservice misfires, Datadog isolates exactly where the latency is happening instantly.
Right.
Because in the AI era, the financial penalty for system failure is just absolutely brutal.
It's unforgiving.
every minute your system is down is a week's worth of revenue,
Yeah.
and trust you just hand it over to your competition.
That nervous system analogy is exactly how you have to look at this. If you're operating complex distributed AI applications across multiple cloud
You're
environments,
blind without it.
you are functionally blind without advanced observability software. You simply cannot operate at global scale.
No.
And from a wealth-building perspective, this is why this company is positioning itself not as a volatile, short-term swing trade.
But as a core compounding holding.
Exactly, in a long-term portfolio. When a service transforms from being a nice-to-have IT monitoring tool into absolutely mandatory mission-critical infrastructure,
That changes everything.
it creates a deeply entrenched recurring revenue stream that just compounds year after year.
That mission-critical dependency you just described is exactly what is manifesting in these historic Q1 numbers.
Yeah.
Now let's look at the fundamentals.
To do it.
Because the data that drove this 31% surge is staggering. But, as a risk-aware investor, I have to question the physics of this growth.
Well, let's lay the numbers out first to understand the scale here. The first quarter of 2026 was a historic milestone.
It really was.
It marked their first ever billion-dollar revenue quarter. They brought in $1.006 billion.
Which is a massive psychological and operational threshold for any enterprise software company to cross.
Absolutely. But Wall Street wasn't just reacting to the sheer size of that revenue.
No, they were reacting to the trajectory.
Exactly. They accelerated to 32% year-over-year top-line growth. And the trend line leading up to this is what really caused the explosion. In previous quarters, their growth was sitting at 25%.
Then it bumped to 29%.
And now it has accelerated again to 32%. They also absolutely crushed profitability estimates,
Yeah, the NPS was crazy.
delivering non-GAAP earnings per share of 60 cents, which easily beat the consensus estimate of 51 cents.
And their balance sheet is just an absolute fortress right now. I mean, they're sitting on $4.8 billion in pure cash.
Huge.
Plus, they generated an incredible 29% free cash flow margin in the first quarter alone.
Which is massive.
That translates to $289 million in pure free cash flow.
That cash flow metric is arguably the most important number in the whole report.
Why do you say that?
It means they are entirely self-funding this hypergrowth. They aren't reliant on taking on expensive debt in a high interest rate environment.
Right.
And they aren't diluting their shareholders to fund daily operations.
Okay, but here is my pushback on this.
Go for it.
I'm looking at this analytically, and usually when a software company hits $1 billion in a single quarter, the law of large numbers takes over.
Right. Growth naturally decelerates.
Exactly, because it is mathematically much harder to double a massive revenue base than a small one.
True.
So how on earth are they mechanically accelerating their growth from 25% to 29% to 32% at this massive scale?
It's wild.
It almost defies the physics of enterprise software. What is driving that?
It does defy the usual trajectory, and the mechanism behind it really comes down to the extreme stickiness of their ecosystem.
Okay.
This isn't a single isolated software tool. It's a massive integrated platform.
Right.
Right now, 56% of their customers use 4 or more of their products.
Over half.
Over half. And that's up significantly year over year. Even more impressive, 20% of their customers are using 8 or more distinct products.
So the mechanism is a land and expand strategy. They get their foot in the door with one basic monitoring tool, they prove their value, and then they just slowly take over the entire IT department's infrastructure.
That's it. And once a company has integrated 8 different observability tools into their daily operations,
Oh, man.
tying it into their security, their application performance, their network monitoring,
Ripping it out would be a nightmare.
ripping out that software becomes incredibly dangerous.
Yeah.
It is operationally terrifying for a chief information officer.
Yeah.
It would be like trying to completely rewire the electrical system in your house while all the lights are on and the appliances are running.
That's a perfect analogy.
Because the switching costs and the operational risks are so astronomically high, it gives Datadog incredible pricing power and massive upsell capability.
Right.
On top of that, they just secured their FedRAMP High certification.
Let's unpack that really quick, because FedRAMP High isn't just...
Exactly. It is the highest level of security authorization for federal agencies.
Wow.
What it does is build an impenetrable regulatory moat around government and federal workloads.
Because smaller competitors can't afford the audit.
Right. Cheaper, smaller competitors who don't have the capital to endure the FedRAMP High audit process, they simply cannot legally bid on those massive multi-million-dollar public sector contracts.
Wow.
It locks Datadog in as the default vendor for the government.
The power of that regulatory moat, combined with accelerating growth, well, that brings us to the catalyst timeline.
Right.
Because, as we know, the stock market is a forward-looking mechanism. The billion-dollar quarter is in the rearview mirror now.
It's already priced in.
Exactly. So if you were analyzing this asset today, you want to know exactly what is going to drive the stock over the next 3 to 6 months.
Well, the biggest immediate catalyst was management's decision to massively raise their full-year 2026 guidance.
Yeah, that was huge.
They are now projecting revenue between $4.30 billion and $4.34 billion for the year.
And management teams are usually pretty conservative.
Naturally conservative, yes. So when they raise guidance that aggressively, it signals profound internal confidence in their sales pipeline.
And think about the psychological effect that has on Wall Street analysts.
Oh, they must be scrambling.
Right. If you are an analyst covering this stock, you spent weeks building your financial models, right? You published your price targets based on growth slowly decelerating.
Because that's what usually happens.
Exactly. And suddenly, management drops a 32% accelerating growth quarter and jacks up the full-year guidance.
Your models are instantly obsolete.
Completely useless. These analysts are now forced to scramble and rapidly revise their projections upward just to catch up to reality.
Which creates a powerful, self-sustaining cycle of analyst upgrades and price target bumps.
Continuous positive news flow.
Right. Generating continuous positive news flow for weeks. And that perfectly sets the stage for their next major pipeline event.
The DDOG 2026 User Conference.
Exactly. Happening June 9th and 10th.
Now, usually a corporate user conference is just an industry networking event, right? Maybe some keynote speeches.
Usually. Yeah.
But for a stock trading at these multiples, DASH 2026 acts as a massive pipeline conversion event.
It really does.
What specific AI-native products are we expecting them to unveil that will actually convert attendees into paying customers?
Well, given the massive shift toward AI infrastructure we discussed earlier, we expect them to unveil specialized LLM monitoring tools.
Large language model tools.
Right. They need to show enterprises exactly how much their AI prompts are costing them in computing power.
Because compute is so expensive right now.
Exactly, and show them how to optimize it. When they reveal that product roadmap, it turns conference attendees into active buyers.
Yeah.
And shortly after that, you have the Q2 earnings coming up in late August, which, given the new guidance, is primed for even more upward estimate revisions.
When a company completely dominates a sector's pipeline and continually raises guidance, Wall Street's reaction is violently bullish.
Very violent.
Now let's pivot to the chart, because a 31.33% explosive gap up is not normal organic price action.
Not at all.
We need to explain the mechanics of how this actually traded.
It is a decisive, violent breakout. From a technical perspective, a gap up of that magnitude completely shatters all prior trading ranges.
It's massive.
It indicates extreme, panicked institutional buying pressure. You simply do not get a 31% move on retail volume alone.
No way.
This was heavily driven by the physics of a short squeeze.
Let's walk through exactly how that short squeeze mechanism works here.
Okay.
You had hedge funds looking at Datadog approaching $1 billion in quarterly revenue, and they bet heavily on the law of large numbers.
Right.
They borrowed shares and sold them, assuming growth would decelerate to 20% or lower. The plan was to buy the shares back when the price dropped.
Exactly. But when Datadog shocked the market by accelerating growth to 32%, the stock instantly gapped up.
Which means those short sellers were trapped.
Those hedge funds were suddenly deeply underwater. To stop the infinite risk of a climbing stock, they were forced to issue aggressive market buy orders right at the open.
Just to cover their short positions and lock in their losses.
Right. So you have retail investors buying the good news. You have massive institutions accumulating.
And short sellers frantically buying to cover.
Exactly. That combined buying pressure with zero sellers stepping in acts as rocket fuel. That's what causes that 31% pop.
Looking at the technical structure going forward, where are the key levels?
The critical resistance level to watch is near its all-time high of roughly $201.69.
Okay, 201.69.
If the sheer momentum of this volume can carry it through that specific price point, it triggers a dynamic shift. All the previous overhead resistance dissolves.
So the ceiling becomes the floor.
Precisely. Those prior price headwinds structurally convert into tailwinds. The stock enters price discovery mode, where there is simply no historical resistance to hold it down.
Okay, but as a practical, risk-aware investor, I have to point out the overhead supply zone here.
Let's hear it.
Let's look at the actual ownership structure of this company. Institutions currently own roughly 80% of these shares.
That's a huge chunk.
Huge. And if you look at the trailing 12 months before this massive earnings pop, those same institutions were largely distributing.
Meaning they were slowly selling off.
Right. They were slowly selling off their positions and taking risk off the table.
Mm-hmm.
So with this massive sudden spike to 188, aren't we risking a scenario where major institutional players use this liquidity event to just dump their shares?
It's a fair question.
If you're buying the top of a 31% pop, aren't you just providing exit liquidity for a hedge fund that wants to lock in profits?
It is a very valid structural concern. Whenever you have 80% institutional ownership and a recent history of distribution, profit-taking at the top is a very real threat.
Yeah.
It can certainly cap rapid advances. However, the sheer volume behind the specific breakout suggests that the institutional flow has entirely reversed.
Reversed. How so?
The earnings acceleration was so undeniable that capital, which was sitting on the sidelines, is now being forced to chase the rally.
Ah, so they have to buy back in?
Exactly. Portfolio managers simply cannot afford to be underallocated on the clear winning infrastructure play in the AI space.
The reality of those portfolio managers scrambling perfectly illustrates what market sentiment looks like right now.
Oh, completely.
So what does market sentiment look like? Because the narrative has completely flipped overnight.
Flipped is the perfect word. The sentiment on Wall Street right now is almost unanimously bullish, bordering on euphoric.
Euphoric is right.
We saw Wedbush immediately step in and raise their price target to $220.
Wow.
And the TD Securities came out with an incredibly strong note, calling the quarter an eye-popping print and explicitly labeling it a must-own stock.
Must own. That is incredibly aggressive language from a traditionally conservative analyst desk.
It is. The broader narrative taking hold across the institutional market is that observability is the next big thing.
Not just a software tool anymore.
Right. It is no longer being viewed as just another software category. It is being recognized as the absolute foundational safety layer required to make enterprise AI actually function.
And whenever sentiment gets this frothy and aggressive, the rumor mill starts working overtime.
Oh, definitely.
I've been looking at that $4.8 billion cash hoard we talked about earlier.
Yeah.
You do not just sit on almost $5 billion in cash forever in the tech sector.
Not if you want to stay competitive, no.
Right. And there is a lot of intense, specific speculation right now regarding their board of directors.
The Dominic Phillips edition.
Exactly. They recently added Dominic Phillips to the board. He's a former high-level executive at ServiceNow, which is a company known for aggressive expansion.
Yep.
When you combine a battle-tested enterprise growth executive with nearly $5 billion in cash and 29% free cash flow margins.
The whispers turn to M&A.
Immediately. Strategic M&A.
Right.
Are they going to acquire a major cybersecurity competitor to fill out their product suite?
That would make sense.
Or, alternatively, are we going to see a massive surprise stock buyback program?
Mm-hmm.
Either of those actions would act as massive secondary fuel for the stock price.
Which just compounds the bullish sentiment, right? When a company is that incredibly well capitalized, they entirely control their own destiny.
Yeah, they hold all the cards.
Exactly. They can acquire inorganic growth if they need to, or they can aggressively return capital to shareholders. They have options that their competitors simply don't have.
But no asset is without its flaws.
Yeah.
Now let's talk about the risks.
Okay.
Because my job is to make sure we stay entirely grounded here. And frankly, the valuation on this stock requires a very stark, sober look.
Let's lay out the bear case.
We are looking at a gap price-to-earnings ratio of 608.81.
It's high.
608 times earnings. That is a multiple price for absolute flawless perfection.
Yeah, it is.
At that valuation, you are leaving literally zero room for execution errors. If they miss a single quarterly estimate or if their growth decelerates by even 2 or 3 percentage points.
The multiple compresses.
Violently. A multiple of 600 can compress violently and wipe out a massive amount of equity.
Uh-huh.
That is a towering valuation risk.
It is a massive premium valuation, without a doubt. I do want to add some context to that number, though.
Go ahead.
That GAAP PE ratio is heavily skewed because GAAP accounting requires them to expense non-cash items.
Like what?
Specifically, massive amounts of stock-based compensation that artificially depresses the earnings part of the equation, which blows up the ratio to over 600.
Oh, Okay.
If you look at the actual cash generation, that 29% free cash flow margin, the valuation, while still incredibly rich, starts to look much more justified for a hyper-growth compounding asset.
That is fair, but it's not just the company's internal execution we have to worry about here. There is a massive macroeconomic overhang right now.
True.
As a reminder, we always impartially report the broader economic conditions on this show.
Right.
Right now, you have escalating U.S.-Iran geopolitical tensions. You have rising global oil prices. We have seen broader systemic declines across the overall tech sector.
The macro picture is definitely choppy.
Very choppy. If those macroeconomic factors trigger a widespread IT spending recession, enterprise companies are going to tighten their belts.
They'll cut budgets.
And when budgets get slashed across the Fortune 500, a software stock trading at 600 times GAAP earnings is usually the very first thing institutional investors sell.
Those are very real macro headwinds. And in a normal environment, a high multiple stock would be deeply vulnerable to that.
Right.
But this is where I will offer a direct rebuttal based on management's explicit commentary during the Q1 call.
What do they say?
They addressed this exact macroeconomic concern. Management stated on the record that they are seeing zero material macro or geopolitical exposure impacting their current sales pipeline.
Zero. Claiming total immunity to macro conditions is an incredibly bold claim in this environment.
It is bold, but it connects right back to the mechanics of what they sell. It goes back to your nervous system analogy.
Okay.
If a massive enterprise is looking to cut IT costs because oil prices spiked or the macro environment softened, they might cancel the rollout of a new communication tool.
Sure.
They might delay a massive hardware upgrade for a year. But they literally cannot turn off their observability platform.
Because they go blind.
Exactly. If you unplug Datadog to save money, your entire engineering department goes blind to system failures.
Wow.
It is essential foundational infrastructure. It is not a discretionary budget line item that you can just trim.
So with everything on the table, what's the final verdict? I mean, we've got accelerating fundamentals, the massive technical breakout, but also the towering valuation.
Right.
How do we score this, and what is the actionable takeaway for you as an investor?
Based on the structural tailwinds of the AI build-out, the phenomenal financial metrics, and the upcoming catalyst pipeline, the final verdict for this analysis comes in with a bullish score of 8 out of 10.
An 8 out of 10 is an incredibly strong conviction score.
It is, and it is crucial to understand the investment horizon here. The view is a multi-year hold. This is not a stock you buy today hoping to flip next week for a quick profit.
Right.
They are actively proving that the AI revolution is not a threat, but a massive accelerant to their core business.
Yeah.
When you combine an impenetrable fortress balance sheet of $4.8 billion in cash, a top line that is defying gravity by re-accelerating to 32% growth, and those massive 29% free cash flow margins,
These are incredible.
you are looking at a compounding powerhouse. It is a very rare combination of hypergrowth and supreme financial health.
And that leads me to a final provocative thought for you to mull over as you think about the future of your portfolio.
Let's hear it.
We have spent a lot of time today talking about the massive tech companies building the AI models and the infrastructure companies like Datadog that are monitoring them.
Right.
As artificial intelligence completely transitions from being a fun luxury experiment to becoming absolute mandatory infrastructure for the entire Fortune 500.
Which is happening right now.
Exactly. Consider what happens to the legacy software companies out there that don't integrate this level of deep observability into their daily operations.
Oh, they're in trouble.
How long can a company survive operating in the dark, relying on outdated monitoring, while their competitors can mechanically see and fix every system failure before it even impacts the end user?
Not long at all.
The ultimate penalty for flying blind in the AI era might not just be a loss of revenue. It might just be total obsolescence. Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.